Hello and good day to everyone. In today's episode of Growing Your Tree of Prosperity, I'm going to talk a little bit about something that is philosophical, all right? And I'd like to talk a little bit about why investment and insurance should not be mixed with each other, okay? And what is the background behind this? The background is that you can avoid a lot of bad sales pitches from financial advisors as well as banks if you understand this principle that insurance and investment are actually very different items and they should be kept separately from each other, right? And part of the reason is if an investment product is sold to you, you often pay a high commission of about 2 to 3% on average in annual fees. But if you learn how to invest directly through a broker, you either pay less than $5 a trade if it is a custodian broker, or slightly more than $25 if it is through a traditional broker. In any case, if you were to use a broker to actually purchase your investment securities, you can save a ridiculous amount of money. So this is a very important life skill for you to pick up, right? So do note that the entire motivation behind this webinar, all right, is that you can split insurance from investment. Your cost savings are significant, and because commissions from a pure insurance scheme can also be very, very cheap. Okay, so before we even delve deeper into separating an investment from insurance, we need to have a clearer understanding of what an investment actually means, right? So when you invest your money, you're aiming to grow your wealth over time by taking on some risk that your money can actually be lost, right? So generally speaking, there are investment asset classes for retail investors, including stocks, that give about 7 to 9% returns with a 15 to 20% standard deviation. So it's a relatively high degree of risk, right? Good for most parts of the market cycle, but when there's a recession, you can expect to lose maybe 8% a month, all right? So generally speaking, there's no sugarcoating it. Stocks can be risky for investors, but it is also a source of long-term wealth building, right? So very often, to assist maybe elderly people and people who have a low risk appetite, we would combine stocks with bonds. And bonds produce only 2 to 4% returns with a very low standard deviation. So overall, when you combine stocks and bonds, your returns will go down a little, but the risk that you take in the markets will go down a lot, right? And then on top of it, if you want to complicate your portfolio even further, you can add a little bit of commodities up to 5% into your portfolio. And commodities produce negligible returns with a high risk. It's just that commodities make you a lot of money during periods of high inflation, right? And finally, there is the wild card cryptocurrency. It can return a three-figure return, but standard deviation can be 50% to 100%. So the best way to approach cryptocurrency, as I've said in previous videos, is to allocate just 1% of your net worth into it and just enjoy it when there's a run. And when it crashes, it wouldn't hurt you very badly. Okay. Now, do note that your CPF special account is an investment. It returns 4% and it is riskless, right? The standard deviation is zero. So generally, this is what we mean when we say investments, all right? It doesn't really stray away from these asset classes. And of course, more sophisticated bankers will tell you things like private equity, so on and so forth. But generally speaking, the basic asset classes are here. Okay, so that is an investment, right? So what is insurance? Insurance is when you buy insurance, you're not trying to make money here. You're trying to mitigate risk. You're trying to transfer risk to another party and you want to protect yourself from an unforeseen event, right? So an example of insurance is a put option. A put option is an insurance against a drop in the value of an investment security. Put options have a premium that you have to pay, and put options can expire worthless, but it's fine because if it expires worthless, it means that the stock that you have didn't drop in value, right? So that's the power of a put option. A credit default swap is an insurance against a bond default. So some very wealthy individuals, they buy a bond, they are concerned about bankruptcy, so they take some of their coupons, they give it to an insurer, and they get a credit default swap so that when the bond defaults, they won't lose as much money. They won't lose the full amount of their capital, right? So if you look at this from this point of view, a term life insurance plan is a put option on your human capital, right? Human capital is the unearned income you have in future years net towards the present value, right? So if you buy term life insurance, your job is to make sure that if you die early, your family would still be able to get a certain compensation equivalent to a portion of what you would have earned for the family over the next 30 to 40 years, right? That's why it's good to have term life insurance up to $1 million worth of protection, right? And similarly, when you annuitize your CPF retirement account to CPF Life at age 65, it transforms from an investment into longevity insurance. So CPF Life is longevity insurance. All right. So there is a very major difference between insurance and investment, but the differences can be very subtle and can trip up a lot of these retail investors. We don't learn these things in school. So when we look at someone trying to sell a product to us, right, very often the person will attempt to exploit your greed by selling an investment, right? Maybe in technology stocks, some kind of underlying unit trust. But along the way, they tamba, right? They add an insurance program into this investment. They earn a big commission, and you're stuck with basically a hybrid product, right? Otherwise known as an ILP. Okay, yeah. So that's why a lot of very established fee-based financial advisors believe that you need to split, right, between thinking about your investment and your insurance. Okay, so a very good way of distinguishing insurance from investment is this thing known as a mortality table, right? Mortality table is what actuarial scientists use to calculate premiums that you have to pay for your term life insurance or the annuity rates of your annuities, okay? And what these actuarial scientists will do is that they will predict the year that you will die. Of course, they do it for like hundreds of thousands of people. And if they know that so many people will die at this particular age, right, they would be able to come up with a product that will almost guarantee a profit for the insurance company. Okay, so you need to sort of understand at the back end, right, how these products are being built, right? So one very good way of learning a little bit about what insurance to buy is to befriend an actuarial scientist, because these people design these products in the background, and you just confront them. You say, hey, so what kind of insurance do you have in your own personal portfolio? Right, I've got a couple of students who are from the same industry, and they always tell me that they only have term. All right, they never have whole life. They don't have anything that is mixed with an investment component. All right, okay, so how do we apply this sort of thinking into our daily lives? So how does whole life insurance uh, uh, compare? Okay, all right, so insurance companies charge you a high premium and parks your money in a pool of securities, right? So that's how whole life insurance works. These securities often invest in a blue chip company, sovereign bonds, but generally a large component of these portfolios owned by insurance companies have corporate bonds in them because the return is relatively high, right? The default rate is manageable, right? And it's higher than the returns that they provide for you in the insurance plans. Okay, so insurance companies earn on these portfolio of investments, but they let you earn some returns to increase the cash value over time. All right, so that's how a whole life works. Okay, and a lot of insurance agents would then say that, you know, you can withdraw these cash benefits if you need emergency funds, and they like to talk a lot about how great this feature is, but essentially it's your own money, right? You're putting your money into these bonds. When you need an emergency, you can take your money out, right? But of course, it also reduces the death benefit that you have when the money is withdrawn. Okay, all right. So generally speaking, the problem with whole life insurance is that the death benefit is actually quite small relative to your monthly premiums. All right, so I want you to understand how whole life insurance works. It has a strong investment component. Okay, they label it whole life insurance, but actually you are actually investing it in a portfolio that is predominantly corporate bonds. Okay, all right, so let's try to understand why term life is so cheap, right? And if you do a little bit of Googling, you'll find that the term life policy can be 10 times cheaper than a whole life policy. All right, the insurance company collects the premiums from everyone who buys a term life insurance, and they can invest it any way they wish. And even if they don't, generally they will, right? But even if they don't, they will still win, all right? Because you only receive a benefit from term life if you die during the term. All right, anyone who dies will receive the death benefits, right? Okay, so the insurance company will happily compensate those who die, but the remaining funds after the term ends is pure profit to the insurance company. Okay, and given that I've explained earlier, actuarial scientists have these mortality tables to estimate the average time of death, right? Insurance companies can be very profitable doing this, which is why in my other videos, I do talk about companies like Ping An Insurance that is an SDR in the SGX. And it's a very good low-cost way for you to get exposure to actually own an insurance company. So you can actually benefit, right, from these fantastic mathematical calculations from actuarial scientists. Okay, so the cool thing about term life is that obviously it can't protect you throughout your entire life because there is no cash value. Okay, but they figure out that if they can protect you until age 70, it can be very profitable because most people die after age 70, right? Singaporeans live up to age 85. So it's possible to sell term life very cheap. All right. So if the general population dying after 70 is a low probability event, then term life can be very cheap and very competitive compared to whole life. Okay, so how do we separate insurance and investment? Okay, so you can invest if you learn how to operate a broker, and you are in essence keeping a management fee for yourself. So if you have $1 million and you learn how to invest yourself, you don't have to pay a fund manager up to 3% with commissions, trailer fees, right? You can do it yourself, right? And save 30,000 a year for every million you have. So if you have $2 to $3 million, you're saving 60 to 90,000 a year, right? Which is equivalent to a salary of a PMAT in Singapore. Okay, all right. So you can combine your own portfolio with, like for me, the SAF term life insurance. It cost me $40 a month for a $1 million of protection. Okay, and so this basically is the essence of buy term and invest the rest, right? A lot of financial advisors, they hate this idea. There are always ways to attack it, but eventually, I think the idea is that, as we become savvier, we become smarter, we understand the difference between market risk, and we know how insurance is structured, how they're designed to always let the insurance company win, right? Then you'll be able to learn how to sort of separate insurance from investment. Okay, yeah. And the cool thing about separating insurance and investment is that you're not forced to buy corporate bonds, right? You're not an insurance company. You can buy banks, real estate investment trusts, you can buy Tesla, you can even buy cryptocurrency, right? There's nothing to stop you, all right? I mean, for me, I'll advise my students to always consider getting something that pays a regular passive income. That's more important, right? And hopefully one day the passive income can then pay the premiums for your term insurance. Okay, all right. So essentially, if you want to learn how to separate insurance from investment, you have to do a little bit of DIY investing to save on commissions, and then use it to build up your investment portfolio. And do note that as an investment trainer, I'm obviously selfish when I talk about these slides. All right, you got to understand where my bias is. I would be more than happy to be honest with you that I run an investment course, right? If only financial advisors can be equally honest about their commissions, right? Okay. Okay, the second case study, all right, it's about CPF Life. All right, CPF Life is a form of longevity insurance, and therefore it cannot be treated as an investment. So if you have $200,000 and you put it in your CPF Life, right? If you're age 65 today, CPF Life will pay you approximately $1,100 every month. All right, very approximate. Okay, it is not promised when you reach 65, but generally speaking, $1,100 in today's dollars. That's the best you can expect. Okay, this cannot offset inflation. If you want the escalating plan, then you will get less, right? You will get less at the starting point. Okay, now CPF Life is insurance to ensure that you have enough funds if you live too long. Okay, just note that $1,100 is bare bones. It is about $400 less than what the 65-year-old needs for basic standard of living, right? Based on the Lee Kuan Yew School of Public Policy 2021 study. Right. So the big problem with Singaporeans who are engaging in CPF Life is that we don't know the annuitization rate in the future, right? And the thing is that without understanding the annuitization rate, we cannot predict how much we will get from CPF Life when we hit 65. I can only estimate that it will be about $1,100 in today's dollars then, right? When it actually arrives, it might be way less. And it's way less because Singaporeans are living longer, So when the actuarial scientists use the same mortality table to predict your lifespan, right, you're living longer, so the amount that it pays out is going to be smaller. Okay, so the only point about picking up CPF Life is to prevent a life of absolute poverty and suffering. The Singapore government is not really here to give you a comfortable lifestyle, to make life good for you, but they do want to make sure, they want to alleviate suffering and pain for the people. It is a very noble project. I love CPF Life, but we need to understand it is what it is. It is a form of insurance. And when a journalist in the newspapers talks about things like putting the full amount, the ERS, into CPF Life, and then being able to afford a car, being able to afford a very luxurious kind of lifestyle, that is very irresponsible reporting, because that is not the purpose of insurance. That is the purpose of investment. Okay? All right, so do note that with CPF Life, there is always this risk of over-insurance where you attempt to put money equivalent to your enhanced retirement style of $400,000 into your CPF Life. I strongly discourage that. I think that we should try to put 300,000 and not 400,000 at the moment, right? Based on the numbers. If Singaporeans live longer, yes, you will need $400,000 in today's dollars into CPF Life. Okay. All right. Do note that you are risking your descendants' money, because if you die early, you deny the interest rate that is earned. All right. So in many studies, as well as other financial advisors, have reported that the worst time to die is around the age of 80 years old. All right. Yeah. So that's the problem. All right, with CPF Life. So how do we separate our insurance and investment in such a case? Right. Put enough in CPF Life to give you a reasonable amount, right? You can put full retirement sum. It's about $1,150, but there is a $400 shortfall. Invest the rest, okay? You can put a portfolio of stocks, REITs, and business trusts to generate the dividend income, right? As your rentals increase, there is positive rental reversion. You will find that the rents that you collect from your REITs would increase over time and fight inflation off, while CPF Life guarantees you a fixed amount every month. Okay. Now, alternatively, you can rent out a room in your HDB to monetize your 5-room flat as you get older. All right. Okay. But do remember this. Okay. CPF Life is not something that you can solely rely upon. Okay. It is a fixed income for life. It doesn't fight inflation under the standard plan. Okay. But combined with a dividend portfolio, it works very well. All right. It works very, very well. And so this is not an anti-CPF Life video. It is pro-CPF Life, but we just want to do it the right way. All right, put the right amount in CPF Life. Okay. So once again, this is a fairly selfish slide. I'm just saying that if you split insurance and investment, financial education is therefore very important. If you can successfully understand enough about investing, right, then you can waive away all the investment products available. You can just tell your financial advisor that I know how to invest my money. I don't need endowment plans. I don't need ILP. I don't need whole or universal life, right? It's good for other people who are maybe financially ignorant, but for me, because I know how to generate dividends in my investments, I don't need them in my portfolio. Can you advise better? Otherwise, I'll get a fee-based financial advisor to help me make the decision, and there'll be less bias. All right. But of course, financial education is high, right? If you come from my previews, you know how much I charge for investment courses. I would say that they are priced out of reach for some people, right? Which I admit. Okay, I also want high quality students who are engaged in the class. Okay, but if you do not pay for an investment course, there's no harm picking up finance on your own, right? In the 2000s, I completed 3 of my CFA exams to give myself a financial education, right? You can try and do that yourself, right? Okay, if you like my content, you can subscribe to this channel. You can also buy me a coffee here. All right, if you want to listen to my life story and figure out how the financial independence movement works, all right, you can Google ERM intro and take the first link. And I will catch you on my next video. Thank you very much.